everyone, and welcome back to our accounting class. In this session, we're going to discuss one of the most essential topics in financial accounting. Inventory plays a critical role in almost every business that sells physical goods. Whether you run a small convenience store or a large manufacturing company, inventory affects your profit, cash flow, and financial position. Because of that, accountants must carefully record, value, and report inventory to make sure the financial statements are reliable and comparable. Let's begin by understanding what inventory really means, why it matters, and how companies keep track of it. Let's start with the basic question. What exactly is inventory? Inventory refers to goods that a company owns and intends to sell in the ordinary course of business. For a trading or merchandising business, inventory usually includes goods purchased from suppliers for resale to customer. For a manufacturing business, inventory includes not only finished goods, but also raw materials and work in process, goods that are still in production. On the balance sheets, inventory appears under current assets because it is expected to be sold or used up within 1 year. It's one of the largest assets for most companies, especially retailers and manufacturers. Because of this, any mistake in recording or valuing inventory can cause major distortion in the company's reported profit. Now you might be wondering, why do accountants pay so much attention to inventory? The reason is simple. If inventory is overstated, profits will appear higher than they really are. If it's understated, the company's profit might seem lower than it actually is. This makes proper measurement of inventory crucial not only for accurate financial statements, but also for tax purposes and business decision making. Inventory data helps managers decide when to reorder goods, how much to produce, and how to control storage costs. In short, good inventory accounting leads to better business management. There are two primary systems for recording inventory transactions: the periodic inventory system and the perpetual inventory system. Let's start with the periodic system. In this system, the company does not keep continuous records of inventory on hand. Instead, it records purchases of merchandise in a temporary account called purchases. Throughout the period, the business simply tracks how much it buys. At the end of the accounting period, a physical count of inventory is performed. The periodic system is simple, inexpensive, and works well for smaller businesses or those that sell low-cost, high-volume items. However, one major drawback is that management doesn't know the exact amount of inventory or cost of goods sold until the end of the period. Now let's look at the perpetual system. The perpetual system keeps real-time records of inventory. Every time goods are purchased or sold, both the inventory and cost of goods sold accounts are updated immediately. Modern technologies such as barcode scanners, point-of-sale system, and inventory management software make these processes fast and accurate. With the perpetual system, managers can know the quantity and value of inventory at any moment, which helps in decision making and controlling theft or shrinkage. The system is more costly to implement, but provides more useful and timely information. Let's go a bit deeper into the concept of the cost of goods sold. cost of goods sold represents the total cost of the goods that were sold to customer during a specific period. It's one of the largest expenses for any trading or manufacturing company and directly affects the gross profit. The relationship between inventory and cost of goods sold is straightforward. When you start a new period, you have your beginning inventory. During the period you buy or produce more goods, these are your purchases or production costs. At the end of the period, you count how much inventory remains. This is your ending inventory. So we use the same basic formula. Beginning inventory plus purchases minus ending inventory. The logic behind this formula is that the goods that were available for sale during the period include both what you already had and what you purchased. Whatever is left over in the end has not been sold, so we subtract it to determine the cost of goods that actually went out to customers. Now that we understand how to determine total cost of goods sold, we need to discuss how to assign cost to the inventory items. In reality, prices fluctuate. The cost of raw materials or goods purchases change every time. Because of this, companies must choose a cost flow assumption or valuation method, which determines which costs are assigned to inventory and which are assigned to cost of goods sold. The three main methods are first in first out, last in first out, and weighted average cost. Let's examine each method carefully. First in first out assumes that the earliest goods purchased are the first ones sold. This means the oldest inventory costs are moved to cost of goods sold first, and the newest costs remain in ending inventory. In period of rising prices, first in first out results in lower cost of goods sold because the cheaper, older items are recognized as expenses first. This leads to higher gross profit and higher net income, but also higher taxes. The ending inventory, on the other hand, will be valued at the most recent and usually higher cost, giving a more realistic value on the balance sheet. This method is widely used because it's simple and aligns well with the natural flow of inventory. Older items are typically sold before newer ones. In contrast, last in first out assumes that the most recently purchased goods are sold first, so the newest most expensive costs are matched with sales, while the older costs remain in ending inventory. When prices are rising, this method produces higher cost of goods sold and lower net income, which can reduce income taxes. However, the ending inventory on the balance sheet may be valued at older, outdated costs, which may not represent the true market value. Last in first out is allowed under United States GAAP but not under IFRS, so companies reporting under international standards cannot use this method. The weighted average cost method takes a middle ground approach. It calculates an average cost per unit by dividing the total cost of goods available for sale by the total number of units available. This average cost is then applied to both cost of goods sold and ending inventory. It smooths out price fluctuation and avoids the extreme of two methods earlier. For example, if a company buys goods at different prices throughout the period, the weighted average methods combine them into a single, consistent cost feature that applies to all units. Let's work through an easy example to see how this method affects cost of goods sold and ending inventory. Suppose a company buys 300 units of a product in 3 batches, 100 units at $10 each, 100 units at $12 each, 100 units at $14 each. The company sells 200 units during the period. Under first in first out, the first 200 units sold are taken from the oldest batches, 100 at $10 and 100 at $12, giving a cost of goods sold of $2,200. The remaining 100 units from the most recent batch at $14 make up the ending inventory of $1,400. Under last in first out, the company assumes that new goods were sold first. So 100 units at $14 and 100 units at $12 are sold, resulting in a cost of goods sold of $2,600, and the remaining 100 units from the oldest batch at $10 make the ending inventory worth $1,000. Under the weighted average method, the total cost of all 300 units is $3,600. Divide that by 300 units and we get an average cost per unit of $12. Therefore, the cost of goods sold is $2,400 and ending inventory $1,200. Notice how the method chosen by both the cost of goods sold and the ending inventory balance. Higher cost of goods sold means lower profit, while lower cost of goods sold means higher profits. This demonstrates how important the choice of inventory valuation method can be in financial reporting. In practice, companies choose their inventory methods based on a combination of financial strategy, tax consideration, and industry norms. Businesses in industries where prices are stable may prefer the weighted average method because it's simple and consistent. Retailers often use first in first out because it reflects the physical flow of goods. Meanwhile, some United States companies in industries with rising costs, such as oil or manufacturing, might choose last in first out to reduce taxable income. It's also important to note that once a company chooses a method, it must apply it consistently over time. Changing methods can make financial statements difficult to compare and may require disclosure and justification under accounting standards. Finally, when prices fall instead of price, the opposite effect occurs. Under first in first out, cost of goods sold become higher and profit lower, while under last in first out, cost of goods sold become lower and profit higher. So the impact of each method depends heavily on price trends in the market. Inventory accounting might seem technical, but it's actually one of the most insightful parts of financial reporting. It connects production, sales, and finance into a single picture of how efficiently a company operates. By understanding the different systems and the valuation methods, we gain a clearer view of how businesses measure performance and value their resources. That's all for today's session on accounting for inventory. I hope this explanation helps you see not just how the numbers work, but also why these methods matter in real-world businesses situation. Thank you for watching and learning with me. See you again in the next accounting tutorial, and as always, keep practicing and stay curious.